Good afternoon, everyone. Welcome to the Atlanta Economics Club's January webinar. For anybody that's been here before, welcome back. And for anybody that's a first-time attendee, I hope you come back in the future. You know, we don't really get a chance to brag too much, but we really do have a lot of superstars here on the board. Glad we can call on Mike and Jonathan to talk a little bit about current conditions, the outlook for the economy, the impact on their sectors. And so really excited about our today's content. Just a couple of quick announcements before I get into intros and get this started. Just really quickly, our next event is February 15th. So that's the third Wednesday in February. Again, it's going to be a virtual event. That's with Commissioner William Beach from the BLS. Our next in-person event is going to be the following month in March. We'll be back together at Cox's campus. So be on the lookout for just like emails on how to go about parking and registering and things like that as those events come across. Also in the March event, we'll announce the winner of our AEC scholarship. The scholarship committee kind of spent time over the past couple of months getting soliciting applications and picking out a winner. So at the March event, we'll award the scholarship there. Okay, so with the intros out of the way, just a quick introduction of both Jonathan and Mike. I know many of you guys know them. They've been a part of the AEC's board for several years and a part of the Atlanta Economics Club for even longer. So I know most of you that are regulars here know them very well. Jonathan leads Cox's Automotive Industry Insights team, which leverages data to expand Cox Automotive's deep expertise in all aspects of the automotive industry. The Industry Insights team sort of tracks many aspects of automotive activity, including new and used vehicle sales, supply, prices, retail and fleet demand. Jonathan and his team can often provide pretty unique insights into the sector just because of the proprietary data that they collect from Cox's businesses. Before joining Cox, Jonathan served as Realtor.com's chief economist and also the chief economist at Hanley Wood, which is a media and market intelligence company. Also served in a variety of roles at Beazer Homes, including the Senior Vice President of Strategy and Innovation. He's an executive member here at the AEC, also an active member of the Harvard Industrial Economists and the National Association of Business Economists. Jonathan holds a bachelor's degree in economics and religious studies from Rhodes College and a master's degree in business from the University of Texas at Austin. Mike Skordeles serves as the Director, U.S. Macro Strategist and Senior Vice President at Truist. He's responsible for analyzing the U.S. and global economies and financial markets, as well as helping formulate and communicate strategic just investment strategy for the bank. Publishing commentaries and you know, many of you guys, hopefully, if not, you should try and get them. But he provides very useful like email blasts and communications just on their views on economic conditions. As part of the portfolio and market strategy group, he helps manage over $11 billion in client assets. He joined Truist in 2012 and brings more than 20 years of investment experience to the advisory group there. Before that, he worked at Morgan Keegan, where he was the managing director and marketing strategist, and wrote about the market conditions and the economy. He's again also an executive member at the AEC. He serves as our vice president. He's a member of the National Association for Business Economists and the Investment Management Consultants Association. He has a bachelor's degree from Baldwin Wallace University and has a master's of business administration from here. So with that out of the way, I'm going to toss it over to Mike and Jonathan. They're going to go over just their views on things, and then I'll chime in when they're done, just to have a bit of Q&A with them.
All right. Hopefully you can see the full view screen there. My title for my section, "We're Landing Softish or Not," alludes to the fact that we got a lot of cross currents, and it does look like we are headed towards a recession. But we'll hit that head on probably in the Q&A a little bit more. But let me give you a couple of views here. For the most part, there's been a lot of talk about whether we had a recession in 2022. from our standpoint, we didn't. Up front here, just looking at the big four indicators, and the big four being production, the total employment, real consumer spending, so inflation adjusted, and then real incomes. These are four key things that the National Bureau of Economic Research uses to determine if we're in a recession or not. These are indexed looking at the numbers, and it is quite obvious when you see the pandemic recession of what a recession tends to look like. Yes, that's a bit exaggerated, but nonetheless, you see that the activity in all four of these aspects tends to move down. In the current, like the far right end of this slide, you see that production is weakening. That's a new development. We just got the latest numbers here in the last week or so, and then revisions to the prior month. So we are seeing some weakening there. But we aren't seeing that show up in consumer spending and in real incomes. They've generally flattened out, but we haven't seen them pull back. So again, we're not in a recession in 22, but the bad news is these aren't forward-looking indicators. For the most part, they are coincident or lagging indicators, particularly on the employment side. They are lagging. So it doesn't tell us what's going to happen in the future, just that in 22, we were not in a recession. When we kind of spin forward to where things are going, the forward-looking part of it, and we look at the common recession flags, the majority of them are either have already tripped, so they are red on your screen, or yellow, so conditions are ripe for a recession. And if we look at things, again, the weight of the evidence is it does look like we're heading towards a recession. The only thing that's not tripped to show that a recession is in the offing, or at least the conditions are ripe for it, is weekly jobless claims. They continue to bounce along a roughly 50-year low. We do expect to see those continue to move higher as we move forward. But nonetheless, that is something that hasn't tripped, again, from the forward-looking indicators. Obviously, one of the biggest things is the aggressive Fed tightening. But as I'm trying to show you here on this slide, it isn't just about the Fed. So a lot of U.S. investors and folks are really focused in on the Fed. But this isn't just a Fed phenomenon, just like inflation was not just a U.S. phenomenon. So most central banks around the world have been aggressively tightening. Certainly the Fed has been more aggressive on some levels. And then if you see the dotted red part of the line here, which is the future path of what markets expect the Fed to do in the coming year, you see that it's expected to increase a little bit more. But in the grand scheme of things, the majority of the tightening that's happened in this cycle has already occurred. Even if the Fed does continue to tighten a little bit more than what markets are projecting right now, it's safe to say that the vast majority of the increases have already come through. That said, there is, they long and variable lags that everyone talks about. It's probably been pulled forward a little bit more. Nonetheless, I think it's safe to say that there's still some to come from what's going to impact markets as we move forward. If we look at other leading indicators, and this is the composite of leading indicators, this is from the Conference Board. In our research, every time that's on a year-over-year basis, declined more than 2.5%. And we just got the latest figures this morning. So if I updated this chart, it would be down 6%. So we've definitely tripped another flag there, if you will. And as the kids say, never have I ever not had a recession when we've seen a 2.5% decline on a year-over-year basis for these leading indicators. Again, that just tells us the conditions are ripe. It doesn't mean that we will definitely see a recession in a certain period of time. That's the kind of art of this process is the moving into the where you think it's going to happen. Looking at the full year numbers, these are year over year. Again, total year numbers is that our expectation is that we probably finished close to 1.8, 1.9% on a year over year basis for 2022. We have a little bit of a wider range for 23, but if you pin me down as to the kind of most probable point within there, it's actually a little bit on the positive side, and it's gotten a little bit more positive as we've gotten some more of the data here in January. But nonetheless, that doesn't mean that we won't have a recession. Our base case is still that we see weakening in 2023. We have seen inflation overall. We think it peaked in 22 and will continue to taper as we move forward. This is a view of core inflation, not to say that energy and food isn't important. And yes, parts of that, particularly food, have been stickier. But again, just looking at the core prices, because we know where the food and energy prices have moved. Again, we drive down the street, you see what gasoline prices are. That's not hiding anywhere. But when we see things, particularly the light purple part of the bar, new and used vehicles, which Jonathan's going to nail, so I won't have to go in great depth here, but this is flipped from being a big contributor to inflation readings in 21 and into 22. This is now flipped to being a drag. So this is now working in the opposite direction. And this is without having a recession. If we see a recession, again, it's probably going to accelerate some of these trends. That said, the teal part of the bar is all other parts of core inflation, excluding the reopening sectors and new and used vehicles. And the biggest chunk within that is housing. That is a laggy piece of inflation as well. So again, seeing that it's stabilized here in the fourth quarter of 2022. And as we move into 2023, we expect that to continue to stabilize and move lower. This just gives you a kind of there's a wide range of outcomes as we look at the scenarios. The red line is our forecast growing at again for the full year, 0.3%, actually 2.75% or 0.275% on a monthly basis. That's higher than the pre-pandemic level, but certainly not as high as it has been over the course of the last couple of years. Again, we think that consumer inflation has peaked for a variety of factors, not the least of which, again, is energy prices. But if we see things as far as a recession, we could see an acceleration of some of this downward. That said, don't expect to see a whole lot of month-over-month numbers that are negative. That's usually not the case. Even during the pandemic months, we only saw 3 negative months. If we look at the Great Financial Crisis period, we didn't have more than a handful over that like 18-month period. There wasn't more than 6. And so don't expect to see a full year of negative numbers. That's really not a thing on a month-over-month basis. That said, going close to the zero bubble on a monthly basis is going to be bringing things down. And again, that's where we've seen things the last couple of months. So we've seen things peak. As we move forward, again, it probably bumps a little higher. But if we have a recession, and again, our call is for a recession, we think that you'll see these consumer prices continue to trend lower. So just wrapping it up from my standpoint, we are landing, again, euphemism for a recession, softish or not. It does seem like it's lining up more towards a softish sort of landing, but I think it's going to be hard for us to avoid at least a negative quarter or two. Again, it's probable, but not inevitable. So it doesn't mean that it has to happen. The timing of it is a whole nother thing to really, have another debate about, and we'll talk about that in the Q&A. But we do think inflation stays inflated or elevated for a while. So from there, I'll stop sharing and let Jonathan hop in. Jonathan?
Well, thanks, Mike. I think you set the stage pretty well. And as we've talked about for a long time, I think we could have sessions like this a couple of times a year and probably just use your slides and discuss each one of the topic, because I think there are ranges of opinion out there. And it's very interesting to kind of share those opinions and leverage the expertise that we have that are members of the club. So as Mike said, I'm going to drill in more to the vehicle market. I figured this is a good practical example of what has been ground zero of a lot of what people have been looking at with regards to the impacts to supply chain issues and limited goods. You know, used cars were ground zero for the inflation story and the original, I think, valid characterization of them being transitory, because as we'll go through, that certainly changed circumstances last year. But we continue to see very interesting dynamics. And of course, the auto market, like housing, is very tightly impacted by the credit markets and the change in interest rates that we've been seeing happening in the U.S. economy, and of course will be impacted by an economic cycle and a recession unfolding, if indeed that is the case. But you also may get some practical advice today, especially anybody who's been looking or thinking about being in the market for a vehicle, because circumstances are definitely starting to change and are more likely to be in the buyer's favor sometime this year. But it all depends on what type of vehicle you're looking for. So first, where have we seen the most dramatic change more recently? It's been in new vehicle supply. Last year, really at this time, was continuing an absolutely historic level, low level of supply that we had in the new vehicle market. And it was driven by the supply chain challenges that really began when the whole world shut down factories as part of the response to COVID in 2020. But it really was made worse by issues that again started happening at the beginning of 2022, namely the invasion of Ukraine by Russia really interfered with supply chain and assemblies of vehicles in Europe. We also had an earthquake in Japan that occurred in February of last year that impacted some of the major producer of semiconductors in Japan. And of course, China has been dealing with COVID with their zero COVID policy that has caused a lot of disruption to supply chains in Asia. But those circumstances clearly started to change at the end of last year, changed more positively for North American production for any other region of the world. And you'll see evidence of that in a second. But the movement we've seen has meant that we're starting this year with about 800,000 more vehicles than we had a year ago. It's still a tight market from a historic standpoint, down roughly half from what is normal for this time of year. But it has materially contributed week to week, month to month, to both the absolute level of inventory out there and the day supply. And it's the day supply metric that I find most closely related to the pricing dynamics. And while that continues to be low, we essentially are about where we were a year ago from a day supply perspective, and we very likely will be better than last year in a few months' time if inventory conditions continue to improve. But of course, the devil's in the details. And as I shared, there's a lot of variation in terms of regional ability to resolve supply chain issues and get production back fully up to speed. And you can see that most evident when we take a slice of the day supply of the brands out there. What we see is that the very tight supply conditions are really concentrated in the Asian brands and some European brands. And at the other end of the spectrum, we're seeing mostly domestic brands. But the reality is it's actually domestic brands and brands that have more of their assembly and supply chains coming from North America. That's where we're closest to a more complete or normal level of production and vehicles being delivered to the US market. But even within each brand, we see quite a bit of variation at a segment level. And the reality is we've been seeing this for more than 2 years because it is the effect of prioritization when you're dealing with limited resources like inputs such as semiconductors, but also with labor shortage challenges. The reality is most factories in the auto sector have not returned to a full 3 shifts. And as a result, they generally are dealing with labor shortages that limit their ability even to do fully 2 shifts on their factories. So the end result has been what the industry has produced are only the most profitable and most expensive vehicles. And that has been at the expense of the most affordable and ironically the most fuel efficient vehicles as well. So when you think of it in terms of day supply today, you're really much more likely to be able to find full-size pickups, full-size SUVs, and luxury vehicles as opposed to compact sedans, subcompact sedans, mid-size sedans, and minivans. And guess what? That's where we see the pricing dynamics in both the new and used market being much more challenging to navigate for consumers. And speaking of the pricing scenario, scarcity that we've experienced in the industry has brought unprecedented pricing power to sellers. And these are 2 of my favorite metrics for walking through what that means. The green represents what incentive spending looks like from OEMs in order to sell new vehicles. So it's the total amount of money that they spend relative to the average new vehicle transaction price. And you can see that green line really bottomed out to historic lows. And we have data going back for more than 20 years. And we've absolutely had the lowest incentives, even on a nominal basis, across that more than 20-year period. But we have seen that start to tick back up at the end of last year. In fact, incentives had their biggest monthly increase in quite some time in December, having increased 24%, but that was from a very low level. But at the same time, the average transaction price was $49,507 in December, a new record and getting very close to $50,000. The reality is average transaction price have exceeded the sticker or the MSRP for 18 straight months. I believe we probably have a few more months of that being the case before we start to see a more traditional gap between what consumers are paying and the sticker on the vehicle. But the red line really shows the effect of those strong margins for dealers. It's measuring the average price relative to invoice. So it's basically just looking at the difference of what consumers paying and the cost of the vehicle to the dealer. And you can see that that number has never been as wide as it was for much of last year. But again, in the final months of the year, that number really started to come back down. And of course, this is clearly bad for affordability for consumers. But of course, affordability is not the only thing that moved against consumers, especially last year. What we observed last year was that auto loan rates, both new and used, moved by a little bit more than 3 percentage points. And we actually continue to see auto loan rates move so far in January. So far in January, we're up another 40 or so basis points to above 8.3% for the average new vehicle loan. And for the average used, we're now approaching 13%, having increased almost 50 basis points so far this month. And it's been interesting to look what auto loan rates have done, because really auto loan rates were very slow to move in the first few months of the Fed starting to increase rates last spring. But over the last 4 or 5 months, as other types of rates like mortgage rates started to come down, mainly from yield spreads narrowing from really wide levels, the reverse has been happening in auto as we've been seeing auto loan rates catch up to what the Fed is doing and continuing to widen, which, given what's going on in Treasury yields, basically means that lenders are widening the yield spreads or widening the premium that they're charging for auto loan rates. And generally what we see in the rates is that they've moved the most for used compared to new. They've moved the most for lower credit borrowers like subprime and deep subprime borrowers more than prime borrowers. And as a rule of thumb, every 1% rate change in the vehicle market produces a 3% increase in the monthly payment. So we're basically at payments being inflated by about 10%, even if prices and other factors hadn't changed. But actually, most of those factors, including prices, changed for the worse last year too. So that leaves us to a reality that payments have increased and hit levels that we've never seen. And it's interesting when you look at these increases that range from 28% to 34% compared to 2019. It's most interesting in my view to look at the used vehicle payment, because if you look historically, that gray line was bobbing right around $400. And I think that's because it represents a really critical maximum payment level that a median household in the country can afford to pay. But now we've blown through that with a number that's started to come down at the end of last year, but still over $550. Now, how could households blow through their max budget like that? Well, in reality, I think they didn't. I think who represents used vehicle buyers actually changed, especially in 2022, and richer households with better credit stepped in. That's the only way you can really blow through that budgetary kind of challenge. And we can see that indirectly through credit metrics that we follow in the auto loan market. A couple of years ago, before the pandemic, we created these credit indices to mirror what happens in the mortgage market and what gets reported by the Mortgage Bankers Association with credit availability. And so we're looking through the lens of the consumer. Is it harder or is it easier to get a loan? And are the loans they're getting supportive of stronger buying power or weakening buying power? And what we saw in the indices was that really the second half of 2020, all of 21, and the very beginning of 22 represented expansion of credit, and consumers were able to get the lowest rates, the lowest payments, all factors being considered, that they ever have been, and approval rates were very high. Well, that really started to change dramatically last year, and especially so in the second half of last year. So as a result of tightening and affordability that happened late last year, we're now back to a scenario where it's harder to get a loan year over year, or at least the loans are less attractive compared to a year ago. In general, most loan types are now back to or getting very close to pre-pandemic levels. So we've erased all of the expansion of credit that was really advantageous for consumers, and now it's beginning much harder. But as I mentioned, when you add all these things up, what we're seeing in terms of who is actually actively getting loans is also shifting. So here's data showing you how incomes have shifted. Basically, we've seen consumers shift from lower income levels to upper income levels. For example, above 125,000 gained almost 7% share in the new vehicle market and about 5% share in the used vehicle market last year. But I think what illustrates it best is really what we see in the presence of subprime. That in and of itself is a decent indicator of credit availability. And we basically see that subprime here in the new vehicle market, but similar trends are happening in used, has declined fairly substantially. Historically, the new vehicle market saw about 15% of loans being represented by subprime borrowers. It was 5% in December. And as a frame of reference, roughly 20% of the US population is subprime. Deep subprime, which is about half of all subprime, traditionally was around 7% of the new vehicle market. And in December, it was 0.5%. So we basically are seeing those consumers pretty much drop out completely. And that narrows the pool of who can buy a vehicle in and of itself from a credit perspective. So what are we seeing so far this year? Well, these are estimates that my team puts out every week looking at retail vehicle sales. We basically use one of our platforms and produce a same store data set that aligns very closely with what actual retail sales end up being over time, which require a bit of a lag to get the full numbers. The gray lines for last year were down in total for both new and used retail about 10% compared to 21, which was a record year. But they were down for differing reasons. The new vehicle market was down most of the year because of the extremely tight supply situation. And actually, once we got past August, started to see modest improvement until momentum faded at the end of the year. The used vehicle market started off weak because of a combination of things, including slowly to be issued tax refunds. Tax refunds are a key part of what drives the used retail market in the spring. Last year, while tax refunds were larger, the largest that we've ever seen, they were actually very slow in being distributed, and their unfortunate timing was when inflation was taking off. The war in Ukraine was causing gas prices to hit record levels, and consumer sentiment was tanking as a result. So we never really saw the used car market see its normal spring gains, and then it started losing momentum as those interest rates started to move, and affordability, in my opinion, really impacted the used car market the most. And you basically saw a fairly steady and consistent erosion as the year went on. And I think when we reach certain levels of new prices and new interest rates, that's effectively why we lost momentum at the very end of last year, even though new supply was improving. And used supply was quite a contrast with what new supply was last year. Basically, inventories were down all year long compared to what we had in 2019, roughly about 20% down all year long. But from a day supply perspective, so say inventory adjusted for sales, they were above normal almost for the entire year until we get to the end of the year. So what basically happened was dealers loaded up with inventory, expecting a very strong spring. That spring never quite materialized to produce the sales that they were expecting. And effectively, they were cutting inventory and buying fewer vehicles in the wholesale market from that point forward until the very end of the year. But by the time we got to the end of the year, inventory levels were even tighter, and day supply was back into a normal range compared to 2019. So the conditions were much more supportive of being able to find a vehicle you want, but also creating in a dynamic that used vehicle prices would decline. And actually, there's one other thing that I wanted to bring up so that you know one of the issues impacting the used vehicle market is we are now well into the cycle that always begins when we have a cycle in new vehicle sales and production. And that is the used car market becomes extremely constrained because of the lack of vehicles that were produced and sold in the new vehicle market in the preceding years. And this time it's even more acute because not only did we have a substantial decline in new vehicles, but we also had the most substantial declines in the new vehicle channels that principally feed the used retail market, namely leasing and sales into fleet and rental. So we are very short of younger vehicles, and that makes that part of the market, especially for younger vehicles, intensely competitive for anyone that's looking for a vehicle that's less than four years of age. But the dynamics with supply have really reversed what we saw in 2020 and 21. So following 2 years of the biggest gains in history in wholesale values, as represented by the Manheim Index, this past year saw its biggest decline. The Manheim Index recorded an almost 15-year decline, 15% decline year over year with the price index level in December. So we are starting to see those values correct. Eventually, that will produce more buying opportunities and monthly payment that works for consumers. But for that price to have that impact on a monthly payment, we actually need to see the interest rate increases stopping. And we think we're several months away. I think Mike and I probably share very consistent views with that. So how are we seeing the year start with vehicle prices? Well, January is always a tricky month to judge, but we are starting the year with retail prices actually accelerate their decline, which was a continuation of what happened late last year. As a frame of reference, last year, three-year-old vehicles, which I'm showing here because they really in normal times help you see a normal depreciation trend. Well, they declined 24% last year when 12% is about normal for those vehicles. Well, retail prices only declined 9%, and much of the retail declines really came in the final 3 to 4 months of the year. So retail is now accelerating in declines. Wholesale has started the year on an uptrend. I really don't think that that's likely to persist, even though the supply conditions are tight, because I think one of the dynamics we're seeing with used prices is getting used prices more into a normal relationship for new vehicle prices. So we actually expect that there's going to be more additional higher than normal price depreciation through the spring. But by that time, we should be seeing used prices in a very close historical relationship with new prices. And given it'll be a market constrained world, we think the bulk of the price declines to expect in the wholesale market, at least, will be limited from that point going forward. So Mike, I skipped forward one. Mike brought up the recession scenario and the range of outcomes. I think we're very close on our expectation. We basically see it as a at most plus 1% real GDP gain for 23 if we avoid a recession, and down around 1% if we do see a recession. So that paints a range of possibilities in both the new and used market. We actually, from a volume basis, think that the new market is more sensitive to the question of recession or not. And that's because we've reached this point that the supply chain issues are really starting to diminish. And so the industry is capable of delivering potentially as much as 15 million units to the market. But we actually think what is already happening is that manufacturers are worried about the demand out there. And simply put, they would rather sell 13 million with no incentives than try to sell 15 million in a market that's weakening. And so we think actually the recession scenario produces a supply pullback that prevents us from seeing much more than 13 to 14 million in total sales. We tend to be more conservative on this metric lately. I'm seeing others forecast 15 million. But let's just say we're not so gung-ho on the delivery of new vehicles really snapping back to prior trends. The used market, we think, is set for a down year either way. It's basically challenged the most by affordability, but also challenged by a relatively limited supply, especially in those younger vehicles. And so we think the question of recession or not isn't really as significant as we see in the new market, which would produce a down year of about 1 to 5% following a down year of 10% last year. But a final piece of content I wanted to share, because we've had several sessions for the club in the past talking about electrification. This is going to be another year of gains in electrification, regardless of what the economic cycle does, because I believe we're still in the early stages of the shift to electrification, where what the industry produces is basically going to be what we sell. And this year is going to be interesting because it's going to be a year where we hit a couple of important milestones. We're going to sell more than 1 million battery electric vehicles for the first time in the US, and battery electric share will rise to 8% of the market from 5% in 2022. And if you add in all types of hybrids, we will reach 25% of all vehicles sold in 2023, all new vehicles sold, will be electrified in some way. And why that's interesting is because it sets up that we should be eventually seeing more of these vehicles in the used market. And it means there's a lot of work to be done in understanding vehicle values, because the future of assessing the value of an electric vehicle is more about the battery than it is the number of miles on the odometer. And that's going to be an area where I and my team are going to be focused on a lot of analytics going forward. So that's everything that I plan to share. And Ibrahim, I'll toss it back to you to, I guess, get us started with questions.
Thanks, Jonathan and Mike. Fantastic stuff as always. I thought I'd start with just sort of a general economic question for the both of you. Mike, as part of his presentation, talked about all the different signals for recession and how most of them were either kind of flashing red or flashing yellow. And I'm curious to get your thoughts as to like what might save us from the recession, because looking at that chart, it's kind of looked a pretty significant warning. But what does a miss on a recession look like here?
Yeah, so the biggest thing is it comes back to those income levels. So, the linchpin is jobs and having more jobs. There's been a lot of talk here recently about, are we going to have a Patagonia vest recession, meaning it's going to hit tech workers and other folks, but not necessarily traditional frontline workers, or as the BLS says, production and non-supervisory folks, which traditionally get hit during a recession. It might. And as we've seen here in the last couple months, particularly with the job cuts and announcements and what have you, and we haven't seen those show up in the weekly jobless claims, is it does appear that people are getting jobs because labor conditions remain tight. So again, kind of stringing these several points that I've made just now together is, if people are able to, if they lose their job, go down the street and then find a job, it means they still have income. And if they still have income, it still means they're able to spend, on top of people are sitting on a little bit higher, again, on the aggregate, sitting on a little bit higher cash levels that they may be able to, kind of weather the storm of a recession or a slowdown, or even some modest job losses. So again, that's where it makes it really dicey. This kind of, well, when do you think a recession is going to come in? Is from a forecasting standpoint. We didn't think it was going to be quite as weak in the first part of the year. I know the consensus is there. They think it's going to be a first quarter, second quarter sort of thing. It may end up being a third quarter, fourth quarter sort of thing. But again, it does open the possibility as you push it along of this notion that you might be able to sidestep it somehow. I'm interested to hear what Jonathan might say.
Yeah, well, I agree with you. I think in all the logic that you put forward, I would have answered it. It's the consumer that is going to save us. But I think part of how the consumer saves us is because I think the labor market is unfolding very differently from what you would traditionally see with such dramatic tightening of monetary policy and fiscal happening all in 1 year. Because one, we're just not seeing evidence of stress being created by the job losses that have been widely covered, like in the tech sector and in the financial sector. And part of what I think we may be seeing is, what's been referred to as the employee hoarding, or, businesses essentially stopping to hire and closing open positions, but not really sending off certainly entry-level workers that have been the hardest to find. And as a result, I'm not certain we're going to see any of the traditional dynamics that we see. We may see more white-collar jobs lost, but those are the workers who, as long as the economy doesn't go into a down cycle, might have the most opportunities. And it might be why all of the headline level layoffs that we've seen in the tech sector are just not showing up in the continuing claims, because they're finding work elsewhere, and seemingly finding that work fairly easily. So that can really change a lot of the dynamics. And if we thread the needle with inflation coming down as it has been, even though we may end the year above the Fed's target, forcing them to still go higher a bit more, the pressure on consumers goes from being negative and producing negative real income changes to positive again by the second half of the year. And that's especially true with hourly workers, where the majority of their incomes actually get spent. So what moves the needle for the economy actually can keep rolling, even with housing and auto taking it on the chin and not likely to see up years at all. So I'm a little bit, the one thing that I would differ from Mike, I think, from what he laid out, is I'm still in the 50-50 camp. I absolutely believe that you can't dismiss the recession risk. But I also am not there that it's a 60+ probability kind of event, because we just didn't see conditions unraveling towards the end of the year. If anything, many of the leading metrics actually improved. And one of your traffic lights, Mike, I would say you need to change the yellow and the unemployment rate back to green, because it moved negative a couple of times last year, but we're back to 3.5%.
We moved back down. Yeah, no, it keeps flickering. The other one is that, and you rightly hit it, Jonathan, is that on a real basis, as inflation pressures kind of diminish here, that takes the foot off the neck of a lot of consumers. But again, we're still very solidly in the recession camp. it's the probability of perhaps sidestepping is increased, but again, it's not anywhere near a 50-50. We're still
I'm very
in
eager to
a-
see
yeah.
this week's personal income and spending data, because retail sales really, seem to be the first signal that the consumer is fading.
Yeah.
But I look at some weekly credit card spending data, and the credit card spending data is not reflecting any pullback on the part of the consumer. It's shifting though to all of the services categories that don't show up in retail sales.
Right.
So
Absolutely.
I don't see the consumer throwing in the towel yet. And at the end of the day, that's what that question depends on.
Yeah.
That's
The other
right.
one
And-
too
and I mean-
is ZipRecruiter. There's a ZipRecruiter number that goes back to both of our points of, it sounds like particularly in tech, within tech hiring, they are getting jobs within 3 weeks of getting on ZipRecruiter. So it's a lot faster than it has been in the past. So I think again, that's contributing to this ability to get a job quicker. And again, that was specific to tech jobs.
I mean, one of the things that we noticed in our sector is that, some of the more troubled areas of the economy, so if you took like housing and construction, for example, which have been hit pretty hard, they've done worse, but at the same time, like there's hiring going on in other areas of the economy that are looking for those kind of workers. So like hotels, they're still kind of ramping up to try to get back to pre-pandemic trends. Healthcare is still hiring, and like warehousing, which is where my company does quite a bit of purchasing. Right, we're always looking for more workers, and so there, it's an odd kind of dynamic where it sort of depends on where you sit in this economy, because there are parts that are getting hit pretty hard, but there are other parts that still feel like they're ramping up quite a bit there. So that's good commentary from both of you too. I wanted to pivot a little bit regarding Fed and Fed policy. There's something of a disconnect right now between like what the Fed is saying they're going to do with interest rates and sort of what like markets are expecting. And I think there are a lot of people in the markets that are kind of in the camp that Mike's in, which is to say that there's a high chance of a recession, and when the economy falls into recession, the Fed's going to start cutting rates. And so by the time you get to the end of this year, probably you're potentially looking at interest rate cuts. And the Fed has kind of stepped in and said, like, we're not planning on cutting rates this year. So I'm a little curious as to how you guys see this kind of disconnect resolving itself. Do you think the Fed's going to blink if the economy slows down in any noticeable way? Do you think the Fed might be okay with a little bit higher inflation if inflation proves to be stubborn, but the economy is slowing?
I'll let Jonathan take that first, but I have opinions. I definitely have opinions on that.
Yeah, well, I believe that the Fed has already pivoted, but it's pivoting to a finally much smaller increases. I don't think they're done. I think they are going to show the financial markets that they're not going to give up until they get to 5% at least, unless we really get some sort of surprisingly negative number in some key metrics over the next couple of months. Again, because they do want to see the level of inflation get materially closer to their target. But that said, I honestly believe that if I were on the Fed, I would be okay with 3% inflation. There's a lot to be argued. Actually, what is the ideal level of inflation, and the difference between 2.5%, and 3%? And they're not going to adjust the goalposts right now. And I think that was actually a question that was posed to Powell in the last meeting, and he basically said, no, we're not going to change the target. But I think philosophically, as we see inflation come down and we're getting closer to that, I think that becomes real. But I do believe we're in for a few more increases, and I think I'm taking them for their word that they're going to leave rates at whatever peak level we hit for the duration of 23, again, because we're not likely to see inflation below 3%, by the end of the year. And so, if we do have job losses or we do have some weakness in parts of the economy, they will have stuck to their knitting with regards to really trying to see inflation get back to to their targets. So, that's sort of what I'm thinking. I think it's more of a 2024 pivot to lower rates, and eventually getting us towards something where the Fed funds rate is closer to their to the real rate, of 2.5%. So we've got room to improve, and we're close to the end of this kind of tightening cycle. But that basically really makes 23 a difficult year for both businesses and consumers in terms of that the costs that are driven by that level of rates.
Yeah, I agree. The couple pieces that I would add, one is I think markets are prematurely looking for cuts because they're using this old framework of when you have a recession. The last two recessions, they've gone to zero interest rate policy. I don't think they're going back down to zero interest rate policy. We would have to have some, massive exogenous shock again, and we're just not lined up for that. We're lined up for a garden variety recession, which really doesn't merit, or come to the level that merits, hey, we need to take interest rates to zero. So that's piece number one. Piece number two, I agree with Jonathan. We're likely to see them go higher than what markets expect. So maybe it's even beyond 5%. But the other thing is looking at these inflation trends, and I showed that core inflation trend, particularly on the housing side. It's just not coming back down, and it doesn't. That's the way the trends work within housing. Is it takes a long time to work its way up, and then once it gets up there, those inflation trends don't really work their way down very quickly. So it's going to be stickier. So this notion that we're going to go back down to sub 2% as far as what the Fed's target, so PCE and all that sort of stuff, core PCE, I don't think we're going to get down there. So again, I think I agree very much with Jonathan's point that they're going to allow or tolerate a little bit higher inflation than the target. The other piece is they talked a lot, particularly pre-pandemic, about this notion of being symmetrical. So it was so far under the target for so long. Are you going to tolerate it to be higher? I don't think explicitly they're going to really go there and again change the target, but I think that they have to be at least willing to tolerate higher inflation readings for a period of time as we work through there. So again, neither of those pushes towards a dramatic cutting of rates and likely keeping rates higher for longer. And if they just keep rates steady, that's inherently tighter policy. So those are things to remember. And then the last piece is the size of the balance sheet, which again, that can impact rates a lot more than people are really giving it credit.
So I've got a ton of other questions. I do want to get some from the audience here because they put a lot in the Q&A. So just a quick question for Jonathan. In the chart of the vehicle availability by type, the low availability types were mostly compact and small cars, but the very low supply category was high performance cars. What cars fall in that category? And then are they going to be like the Dodge Challengers and the Chargers, or the Porsches and Maserati like the imports?
Yeah, high performance are indeed basically a very small subset of principally sedans that have that are beyond just sports cars. And so, yeah, part of the issue is that a lot of those cars are being eliminated. A lot of the traditional vehicles are being shifted towards electrification. And so some of that category is caught in this transition that we're going through overall. But they are not the exotics. So we're not talking about McLarens and things that are produced on you can count them on your hand basis when we look at that category.
I had one other question that sort of ties around the auto, and I guess I can make this broader. You talked a lot about like how supply chain disruptions really limited the amount of supply on the auto side, like in 2020 and 2021. I was wondering if you're noticing any trends on the manufacturer side to kind of ensure the industry against those like future supply chain disruptions. And then the broader question is just like, how do you guys view the reopening of China in general? Like, China's gone through this kind of extended period where they had zero COVID policies, but they're now beginning to relax some. And there's differing forces here. Like on one end, that's great for supply chains that China's reopening. On the other end, that means like more demand for commodities and things like that. So just your general views on China aside from the auto-specific side.
Well, on the production side, I would argue that, so we're dealing with this kind of working your way through the ripple effects of supply chain issues with a lack of components. Manufacturers are actively deglobalizing and building resiliency. And so in the case we were too dependent on Asia for semiconductors, there's more being developed here. But I would say more broadly, almost every manufacturer is looking at multiple sourcing that's closer to home, so to prevent potential issues like we've gone through. And I would say, one, that adds to the inflation aspect of the vehicles being produced. We're embracing a higher cost production model than what we've lived with for the last 30 years. And second, there's a lot of time necessary to get some of those components in place. So in the interim, I think capacity has been taken out of the market. So I don't believe the US could sell 17 million vehicles within the next couple of years, because it's just not in the capacity that can feed our market. And it's a reason to believe this supply constrained situation can last for a few more years, not as acute as what we lived through last year, but definitely can play a role. And I'll let Mike jump in on the China thing, but more broadly, yeah, China not only created problems for us in 2020, but they lingered through 2022. I would say that's where you have the most sort of movement in the industry is taking away dependence on China, and how China then indirectly influences some of the other pieces of the supply chain. So there's probably more of a movement away from all aspects of Chinese production than we've ever had before, but we're absolutely still impacted by their COVID policies, because it's one of the lingering things that's preventing Japanese and Korean production to get back to their normal level of production.
Yeah, on the China stuff, Ibrahim, you covered most of it. So I think your summary was actually along where my thinking is. The one thing that I would point out is that we have not seen Chinese consumers, travelers around the world for roughly 2 years. For the most part, they've been absent. And in places like Europe, think of places like Italy and Greece and Spain that are tourism driven economies, and they had record years in 2022 over the summer without Chinese travelers. So you add in Chinese travelers into that mix, I think you're going to really strain some of these pieces, particularly in Europe, but also in the US and other parts of the world, adding these additional people. So I think that's one of the impacts to the China reopening and allowing whatever, or disallowing whatever, moving away from zero COVID policy does have an impact that folks that really aren't giving enough thought and credence to, that really does impact, again, particularly on the travel side.
Well, unfortunately, we're running out of time here. I do want to respect everybody's time. We have plenty of other questions that were in the Q&A. Sorry we didn't get a chance to answer them all. But again, we're all on the board here. So, if there's anything really pressing, I'm sure you can find our emails somewhere on the site. Thank you, Mike and Jonathan. Again, this is a fantastic kind of presentation. Great information as always. For everybody that attended, thanks for coming. Next event, February 15th, that's virtual. Following event, March 15th, in person at Cox. Okay, and be on the lookout for emails and information about those as they come up. Talk to you guys soon.